guys, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and we're going to continue our strategy discussion today with the Jade lizard. Now, the Jade lizard is something that was actually coined by Liz and Jenny here. It's actually a fantastic strategy, which is a neutral to somewhat bullish assumption, and it's something you're really only going to learn here. So we're going to discuss it today, and we're going to explain why it's so great. So when we're talking about the Jade lizard, basically it's the combination of a short call spread that we're selling and also a naked short put. So when we look at this slide here, we can see how the profitability is laid out. So when we look at the top here, we've got the short out of the money put on the left side and the short call spread on the right side. So essentially we're selling an out of the money put and an out of the money call spread. So at expiration, we want the stock price to be within that range to give us the most profitability. Now, one thing you're going to notice is that that arrow above the short call spread actually continues on past the short call spread. And we're going to explain why that is in a little bit here. So again, looking at the breakdown of the bottom two sections, we've got the short put, which is a bullish assumption. So remember, with a short put, we're essentially selling the right for someone else to sell their shares to us at a certain strike price. So we want the stock price to be above that short put at expiration so that our put is out of the money and worthless, and we continue to keep that credit and get 100% profitability out of that trade. Now, when we sell this out of the money call spread against it, which is a bearish assumption, if we were just to sell that call spread alone, we would want the stock price to actually go down or stay the same, which is the opposite of the short put. But when we combine the two, our short put is going to be essentially worth more than our short call spread. And if our total credit is bigger than the width of the call spread, it turns into a neutral to bullish assumption. And we're going to break that down a little bit later here. So when we go to the next slide, there's a few best practices that we want to keep in mind when we're trading the Jade lizard. So the first one is that our short put should be about 70% of the credit. So we like to usually collect $1 for the Jade lizard, but we want to make sure we collect a little bit more. So maybe $1.03, $1.04, $1.05, anywhere above $1, because when we sell that $1 wide call spread, if we're trying to collect $1, we want to be collecting more than the credit, or more credit than the actual width of the call spread to give us that upside profitability as well. So we want about 70% of our total credit to be on the put side and about 30% of our credit to be with the short call spread. And last but not least, we absolutely need our total credit to be greater than the width of the call spread. And that's what's going to give us that upside profitability and give us no risk to the upside as well. So going to the next slide here, we're going to break it down with a couple of numbers and an example. So let's say we've got the stock price at 90, and we go ahead and sell the 80 put for 71 cents. So again, if the stock price is anywhere out of the money, so if the stock price is above that 80 strike, we're going to keep that 71 cents. Now, we're also selling a short call spread, and we're selling it for 32 cents. So you can see that listed here, which gives us a total credit of $1.03. Now, we have no risk to the upside on this trade, and that's because we have a $1 wide call spread, and our credit was $1.03. So at expiration, if the call spread's in the money, so let's say the stock price goes to 100 or 105 or 110, it doesn't really matter. As long as this call spread is in the money at expiration, we're going to have no risk to the upside. So again, if the call spread is in the money, we're going to have to buy that call spread back for $1 at expiration. However, we collected 103. So since we know that the collection of the credit we received originally is going to help us later with this expiration trade, so if our call spread's in the money, we have to buy it back for $1. But since we collected $1.03, we still have 3 cents of profitability, which will essentially cover our commissions on this trade. So we'd pretty much break even on this trade if we were to sell this for 103 and the stock price totally blew out to the upside, which is better than losing any money at all. So the Jade lizard is a great trade for neutral to bullish assumptions, and essentially we want the stock price to be within that range of 80 and 95 in this example, because if that happens, we've got our out of the money put that will expire worthless and our out of the money call spread that will expire worthless, and we'd essentially keep that total credit of 103. However, if the stock price goes above our short call spread, we would probably break even on this trade given commissions. So we'd have an extra 3 cents since we'd have to buy back that call spread for $1, since it would have $1 of intrinsic value. And we'd be able to pay for the commissions with our extra 3 cents here. Now, this is a great trade because if we want to own the stock, we can own it at a lower price. So just looking at these credits here in our previous discussions of break-even prices and cost basis reduction, if I sell this strategy and let's say the stock price goes to 75, so now our put is in the money. We would have $5 of intrinsic value in our put. However, instead of just buying the stock outright at 90, now we would own the stock at a much lower price. So let's just talk through this example and see what might happen. So let's say the stock goes to 75. Now I would be put the stock at 80. However, I received $1.03 in credit. So my break-even point would be 78.97. So we basically take that 80 strike, subtract our $1.03 from that, and that gives us our break-even point. So again, this is a great way to get long an underlying if we're looking to essentially own those shares at some point in time. So instead of buying the stock outright at 90, I would now own the stock at 98.97. So it's definitely a great way to get long an underlying and collect some premium and essentially lower our cost basis by over $1,000 here. So this is a great strategy for not only encompassing a neutral profit range and having no risk to the upside, but if we want to become long, we can do it at a lower price, which is always great for us. Now let's get to some takeaways for the Jade Lizard. So again, the Jade Lizard is a neutral to bullish strategy that takes advantage of volatility skew. So this is another great thing about this trade. When we talk about volatility skew, we're essentially assuming that the puts are trading richer than the calls. So if I'm selling a naked put, that's going to help my overall credit and allow me to pretty much go farther away from the stock price if I want to essentially collect $1. So I'm going to be able to go much farther away from the stock price on the downside. And since the calls are going to be trading cheaper than the puts, if I'm selling this call spread, it's going to allow me to pretty much get a little bit further away, and it's not going to cost me as much to buy that 96 option that we saw in the previous example. So when we're trading undefined risk, essentially we can collect a larger credit and we'll have a higher probability of profit. But since we want to define our risk to the upside, which also makes this trade available in IRA accounts, it's essentially going to allow me to buy that 96 call from the previous example for a lower price than if calls were trading richer than the puts. So all in all, this total trade takes advantage of volatility skew. And another takeaway here is that it's one of our strategies for underlyings under $75. So we're actually going to talk about the big lizard in our next segment, which is essentially the combination of a straddle while we're still defining our risk to the upside. And that's something that we would look at for higher underlyings, but the Jade Lizard is great for lower priced underlyings just because of the fact that we can take advantage of this skew, sell a cheap out of the money call spread against our naked put, and essentially collect a large credit and have a high probability of profit. Another great thing about this trade is that it can be used as an earnings play because of its wide break-even price. So when we're talking about earnings plays, we want to be able to cover the expected range or expected move of the earnings announcement, and that's something that you can easily do with a Jade Lizard here in most cases. And lastly, there's no risk to the upside if set up correctly. So it's super important to make sure that whatever our width of the call spread is, we're collecting a total credit that is higher than that width so that we have no risk to the upside, because when we're dealing with spreads, even if our call spread goes in the money totally, we just have to buy back that spread for essentially intrinsic value, which is going to be the width of that spread at expiration. So as long as our original credit was larger than that, we're going to be okay. So this has been Jade Lizards. Tune in. Our next segment is going to be on Big Lizard, which is essentially a different combination of these strategies and different legs, but it's going to be a good opportunity for larger priced underlyings. Thanks again for tuning in. My name is Mike, and if you have any feedback at all, shoot me an email at support@doe.com, or you can tweet us at doe trading, at Trader Mike. Thanks and have a good night.